Inflation is actually running a little hotter than markets are expecting, yet investors don't really care. And as much as I don't like making controversial opinions on this channel, I think this is exactly what markets had priced in throughout 2022. This is a sign of the incoming bottom in the S&P 500 as market participants are not reacting to any of the bad news. Because obviously last year, both bad and good news was counted as bad by markets as we saw one of the biggest routes in the S&P 500. That is exactly what I want to discuss in this video by analyzing some important charts and also looking at valuation metrics for the stock market. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's get right into it by addressing the big headline news and concern amongst most investors, which is the idea that services inflation is starting to tick up faster than other prices are coming down. You can see that trend extremely clearly right here. Goods in the yellow are coming down. Prices for CPI are falling as a result, but what's in the red when it comes to services is still in an uptrend. Now, personally, I don't think this is as much as a concern as the markets are making it out to be. First of all, we should realize that goods inflation coming down is the main driver of how people experience inflation on Main Street. People use goods, which are obviously commodities and stuff they buy on a day-to-day basis, as a metric for how inflation is doing. If you were likely to go to survey out to any well-informed US household, they would realistically now say that yeah, inflation is starting to come down a little bit. I'm not seeing prices rise as fast, used car prices are coming down, and obviously my household wealth has collapsed. And that right there is what markets really care about in 2023. People forget that unlike the 1970s, today we are much more driven by expectations of inflation, not just what the core number is at today. The expectations of inflation are lower over the next 2 years than where we are today. And that's what the stock market and bond markets truly care about. Inflation, as you can see on a CPI basis, has already rolled over. Even if the current print was a little bit higher than analyst estimates, it is still lower than the prior month and still way lower than what we were at back in June of 2022 at over 9%. This is exactly the trend the Fed and investors really care about. So as long as this trend holds, the market is going to continue performing what it's doing today. Unless all of a sudden in March CPI prints in at 8%, markets are likely going to start discounting the data that's coming out from all these readings. And why would that happen even though CPI services are going up like crazy? Well, because services has historically always lagged goods inflation over the past 30 to 40 years. You can see that very clearly. In orange, the line has always lagged the performance of what's happened in blue, which is obviously consumer commodities and goods. Goods have collapsed because supply chains have improved drastically from a very short-term inhibited slowdown in 2020 and 2021. I talked about this a lot last year. At some point, this is going to roll over, and we already saw signs in the summer of how prices were starting to correct when it comes to semiconductors and key critical components in so many devices. When that starts to correct, margins are going to improve, prices are going to start to stabilize for consumers, and that in turn is going to lead inflation expectations to stabilize. And yeah, even though goods has come down, the reason services has stayed up mostly is because the labor market is so tight. There are still lots of jobs out there, and freelance work and self-employment is still at an all-time high in the US. People are still creating content and doing their own businesses like crazy, which is obviously driving up the demand for services. But as you can see in the 1970s right here, the peak, even though goods inflation peaked out, services actually still remain quite elevated. And we saw a very similar fashion right here where goods inflation collapsed, but services took another 6 months to fall back down and actually fall a lot lower and a lot faster than goods. We saw a very similar situation here in the early 2000s in the dot-com bubble, which is very similar to what's going on today when it comes to the bear market. Goods inflation started to peak out in 2001, yet services started to peak out 6 months later in the summer of 2002. And that is likely why current services inflation trends are going to start to roll over later than what the actual headline CPI is doing. And plus, it's also known that services are a really good indication of what the economy is doing. And I bet you it's one of the reasons why GDP has come in so strong, because there's still lots of jobs out there for lots of people. We can see that shelter has come down, transportation has come down, household supplies has come down, but obviously the only thing remaining is services. So when that starts rolling over, core CPI will start falling near 4 to 2%, which is what the Fed eventually wants. And it's expected that within the next couple of months, shelter is going to start going negative on a year-over-year basis, meaning people are going to be underwater on their mortgages sooner rather than later. And why is that important? Well, right now, US monthly rents are still rising on a year-over-year basis. And this is actually a little bit more of a concern than services rising. Shelter is obviously, like I showed you, declining potentially on a year-over-year basis as we head into the first quarter. But it could start upticking on a month-over-month basis, even after the recent decline that we've seen since the summer. And that's because rents continue to go up. This obviously is dependent on apartments particularly, but this is something that's going to still drive inflation if the shelter CPI decides to tick up. And that is obviously more of a concern in 2023 than anything else. And again, I think this is mostly driven by what the labor market is doing. As more people have jobs, rents are going to stay stickier. Because at the end of the day, most renting is done by people that are moving out for a specific job from their family. As for how is this going to affect stock market valuations, well, like I've said over the past month, the S&P 500 has already formed a bottoming pattern. We've broken out of this aggressive bear market downtrend, and we did indeed make a higher low from the low that we made in the middle of December. This is a textbook pattern of markets bottoming in the short term. Unless macroeconomic situations deteriorate so much that inflation starts to tick up on a year-over-year basis, markets, in my opinion, are going to stop reacting to that data sooner rather than later. And that's a big reason why markets are rallying, even if yields are going up and even if market participants expect the Fed interest rates to have a lagging effect on the economy. Because believe it or not, even during a rising Fed funds rate, markets do perform really well. Most of the time, the Fed funds rate is being increased at a time when economic strength is way too high. That's what we're seeing right now in the labor market. And in a normal environment, that's what we want to see. So markets and EPS earnings are going to start ticking up on a year-over-year basis in 24 and 25, which is what markets are trying to price in right now, because obviously we're running 6 months ahead of today. And typically what happens during these rate hike cycles is markets see an initial shakedown like we saw in 2015 and 2018 before markets start rallying higher. And no, the Fed does not need to start cutting rates immediately for markets to bottom like we saw back here. And even if you look at the PE ratio of the S&P 500, it is down significantly from where it was in 2021 and even when it was in the 2000 dot-com bubble. And even though it is ticking up a little bit over the past month, which is leading many investors to question whether or not right now investing is a great time, you need to realize that PE ratios always tick up at the bottom of a market because earnings are now down and the pricing is starting to go up. As obviously the market is forward looking, the PE ratio is naturally going to expand at the bottom of a bear market cycle. That's what happens at every single bottom of the market, and this is going to be a no different situation. If you account for the growth mix in software and the insane margins most S&P 500 companies are seeing today compared to where we were over the past 20 years, this PE ratio at the first standard deviation is not too expensive relative to where markets have been over the past 4 years. And obviously this PE ratio does not take into account indexes like the ARK Innovation ETF and companies within this ETF that have been destroyed over the past 2 years. This is the wealth destruction we've all been talking about. Companies are down 80 to 90%, even some in my own portfolio. Yes, that does mean some companies might not make it out of this situation, but it also is creating opportunity for companies that are being driven mostly by algorithms and not fundamentals. This is exactly what the correction entails, and based on the fact that the ARK Innovation ETF has kind of stalled out and is forming this traditional double bottom pattern, there's a very high likelihood that a lot of the pain in this specific index has already been done. And when we do eventually get out of this bear market, the US 10-year and 2-year yields are not going to matter to most investors. We're already starting to see that divergence as the yield has collapsed and is starting to rally over the past month, yet markets are still performing as usual. And that's obviously because in the long term, yields don't dictate what markets do, because that would mean that the stock market would have given us way more negative returns than positive returns. But as we all know, the market performs on an inverse basis to what the yields truly do, and yields over the long term always go down because the US government always has to print money at some point. And so if you're really looking for that initial confirmation of a bottom, it's likely going to come when the Fed starts pausing interest rate hikes. But obviously, guys, that is just my take on the situation. I personally continue to invest in some of my favorite companies cautiously over 2023, even though I know some will have a more difficult time than others. I'm obviously going to use this massive decline in valuations as an opportunity to invest in some more riskier assets, but also as an opportunity to dollar cost average into index funds. As usual, let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.